Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name's Seth Krussman, and I'm joined here once again with Ben Brayshaw. How are you doing today, Ben?
Good, Seth. How are you?
I'm doing fantastic. I'm bringing back fantastic, by the way. It's been a while since I've thrown that one out there. Speaking of fantastic, Dan Michelon, how are you doing today?
Very good. Very excited.
Wonderful.
It's oozing out of his mic.
Dan is a partner with Brayshaw Financial Group, and it's always a pleasure to have you on the show with us, and can't wait for what nuggets you're going to share with our audience today.
Well, hoping to find some good ones. Speaking of that, I think we got a story to share about a found nugget. That's going to be exciting.
Okay, I think there's going to be some play on words going on throughout this episode today, folks. Speaking of episodes, we have a show for you today. We do, and we can't wait to get down to some of the personality types. There are several different kind of personalities when it comes to working in finance, and you might be a couple of them.
We've met all of them.
Yeah, you might be all of them, depending on what day it is. But understanding who you are and how you relate with money is what we're going to be talking about today. Trying to shed a little bit of light on some of these places that we just haven't looked lately. But yeah, it's going to be a great show.
I got to tell you, Seth, that we have met some wonderful people. We've met people who have some different appetites around money, and that's been interesting too. But money's a super personal. I guess that's probably all you need to say. It's super personal to everyone, and it means something, and that drives a lot of our underlying, kind of God-given traits about who we are.
It's emotional. Everyone gets emotional about their money.
Yeah, especially when the market's going down.
And there's also the fact that it's one of those things that we all share a relationship with. At some point in time, I don't know. I've yet to meet the person that doesn't have a relationship with money of some form. It's not relationship counseling here today on Money on Tap. We're going to be talking about you and your relationship with money. But before we get going too far down the road with that, it is time for Money in the News.
Well, first up today, we have Disney adds fewer streaming subscribers than hoped. Revenue falls short. Now, this is out of the Wall Street Journal, written by Eric Schwartzel and Allison Prang. Now, this is really interesting. So, Disney comes out of their quarter, and they were expected to have 109 million subscribers, and they only ended up with 103.6, which is, not a huge ad. I mean, it's still, they were the fastest breakout. The article goes into saying how they broke out of the subscriber base faster than I think even Netflix and so forth. But they're seeing this significant subsiding that's concerning the stock, which has it down basically 20+% since its high, or maybe even higher than a bigger drop than that. And people are just saying this may not be now coming out of COVID and the lockdowns easing and all the different things that are happening there, that they're really, I guess if you lock everyone in the basement, then, subscriptions are going to go up. We're letting people out, so, now they're going to go down. It's just interesting to see how that's affecting the market a little bit on this stock. That's for sure.
Well, hopefully, I think that less viewership online means, more tickets sold at the gate. I think that's hopefully going to be the outcome for them, and to be expected.
Do you have Disney Plus?
I do.
Yeah, I do. Seth, do you have it?
Yeah, I do.
Okay, so we're 3 for 3, and they just raised it by $1 a month. Did you see that?
I did.
Yeah.
Yeah.
Did you think twice about it?
No.
That's $103.6 million more per month that they're getting automatically just by nicking that thing up a little bit. I mean,
and they'll always have the control to do that. I mean, it's still only roughly half the cost of Netflix.
Yeah, I mean, they got a whole nother $700 million a month they could raise this thing. That's the way I look at it.
If you got young kids, it's a critical service. There's no way you're doing without.
Not anymore. Not anymore.
Yeah, I think one of the things that's so unique about Disney is just Dan, you mentioned ticket prices at the door. We didn't even tap their cruise lines. There's just so many facets of Disney, and to me it's a legacy buy. It's like you're either a Disney family or you're not, and like we all are. And I don't know, you just don't even bat an eye at it. It's like, why wouldn't I have Disney? It's available, and they've done a great job during lockdowns of still creating that content that nobody else out there really has, and it's fresh, and it gave us something new, and I didn't spend the $30 for it. I waited until it became the free option myself, but I'm sure they drove a heck of a lot of money in the door doing that.
The one thing that they have as an advantage that it's really can't be matched is the content. I mean, all of the classic stories that we all grew up with or had ever even heard of, they own it, and no one else can have it, and they've pulled it off of every other platform, and it's theirs to use however they see fit, and they sequence and time out the releases, and
so you're not a Marvel fan, so you've got Pixar, right? There's so much to choose from that content of there's Star Wars,
and they haven't really even tapped the ESPN part, so that the whole sports viewership is an opportunity for them as well.
I think they're going to lock that down too. I think they're going to lock all these pieces down, and you're only going to get through Disney, and it's going to be $50 a month.
Yeah, they could easily see it.
Yeah, I could.
So what is the stock market telling us about corporate tax hikes? If you haven't been watching what's been trending out of the White House, that's one of those things that's coming down the pipe here. Is Biden's going to go ahead and increase some of these corporate tax hikes? Currently, they're saying 21% to 28%, and it's not something that has happened with a ton of frequency, but we do have a little bit of history that we can go back and try to figure out what's happened, and that's what this article is about from Sam Rowe, Yahoo Finance, and there's it's interesting.
We went back and forth on this article. It's kind of interesting because I don't know if I mean, we've watched the industry. We know people can manipulate how you interpret numbers, how the market looks around numbers. If you use this, you can almost find any story to tell when you're looking at returns and history and so forth. So I would probably start off with saying, hey, Sam Rowe, I'd like to see all the data myself. But that being said, he goes into the fact that during the historical standards, each year, I mean, it's like, did I understand it correctly that he was saying that the stock market rises basically 10.3% during years when the tax rate was 50% or higher, and only 10% in which it was below 35%. So he's saying that when the tax rate was over 50%, we had a 0.3% higher gain historically. Now, Biden wants to raise the corporate tax rate from the 21% to the 28%, which is basically bringing it back to where it was when Trump was in office. I mean, that's right.
It's even still less than the Obama administration had.
Yeah, it was like 32.
It was 34. I think he's 34. Basically cutting the difference.
Yeah, so he's taking it back to where it was. And honestly, I don't think that's going to impact the market as significantly as the concerns and woes of inflation and so forth. I do think that
it is one of the things he's been talking about since the campaign. So I think a lot of that effect has probably been priced in.
I think so. I think on some level it is. I think the initial passing of it, we'll see a shock. Sure. Yeah, we'll see a shockwave of it. But I think people realize that we're in for higher taxes. I mean, he said we're gonna raise $4 trillion in taxes over, what was it, 4 or 6 years or something? I don't know, some crazy number. I just don't understand how that's going to happen. But this is one way you start getting there. So it's pretty interesting reading this, now during the I'm quoting this here, during the 5 prior corporate tax rate increases in 1950, 1951, 52, 68, 93, the S&P 500 index posted an average calendar year gain of 12.9% with a positive price return in each instance. This gain was well above the 4.6 average return registered during the 9 annual periods when the tax rate was reduced, and also higher than 9% return for all calendar years going back to 1945. It's interesting.
Yeah. I mean, I think there's a lot of industries that, quite frankly, as we're already experiencing increased inflation, maybe this is another one of those costs that they're able to pass through to the consumer.
They will.
They sure will.
They sure will. Next up on our list. Now, this is interesting. I'm gonna let Dan take this because I think this is his golden nugget here.
It is, and from the great state of Massachusetts as well. So always a cause of celebration for me.
And that's not the adjective I would have used, but go ahead.
So we found an interesting story here about a treasure hunter who had heard a kind of a family lore about some lost money within a home. And this guy was able to, and I guess he's made a little bit of a career out of this, but he was able to work his way up into the attic, and within just under an hour, I believe it was, he's been able to find this long-lost cash. And what it was a heck of a day, great find, but he found $46,000 hidden beneath the floor in an attic. And based upon some of the contents of the box there, they're guessing that it was probably hidden there in 1958, which at that point in time, that total, that $46,000 in cash would have been worth in today's dollars about $421,000. So that's a heck of a rainy day fund to bury in the floorboards.
Well, I was just joking around when we were talking about the article before, and I was like, that's probably like $500,000 in today's dollars. And when we got to the end of the article, it was $421,000 equivalent on the inflationary curve, which is, so you think about it, when someone put $46,000 in their attic, they were putting almost $500,000 in their world, in their attic.
It was worth more than the house, I'm sure.
Oh, yeah. Oh, easily.
Oh, gosh, yeah.
I also thought that this was interesting, too, that this guy, Keith, the whole family, is it Wiley? I guess I would pronounce it Wiley or Willie. I don't know, one or the other. But the family had been looking for this money for decades. And they told him a couple of little things, and we think it's in the attic. I mean, if it was in the attic, man, I would have just had someone remove the roof.
Oh, yeah.
Well, at the end of this, one of the things I don't even get into is what was the cost of trying to recover this money? Because they did have several people come in and attempt to, remove floorboards and do all sorts of modifications to the house trying to find this. But
does he get half or what? I mean, for his 1 hour? I mean,
yeah. Yeah, they don't really talk about what his finder's fee was for that. But, one of the things that's interesting here is that he believes that there's a lot more hidden treasure out there, folks. So you can take a look at this and if you've, maybe got a story in your family or a house that you've bought that, somebody said that there's a cash box somewhere, it might be worth your time to get in touch with him and see if you can get it found.
It's interesting. I remember when my parents were redoing our barn up in New Hampshire. They had there was some integrity issues with beams and so forth. So they brought in a bunch of guys, and they found a box of there was some bills in it, and it's like some old collectibles and stuff like that, and like baseball cards and stuff. And it was probably worth like $5,000 or $10,000 worth of stuff in this box that was in this barn behind these boards. That probably some kid, it was his baseball card collection and a few dollars and, maybe, a couple coins that were all silver and just different stuff like that. But it was interesting. It was valued, I think, between $5,000 and $10,000. And the guys working on the barn, I mean, they came running out. They were so excited to have found treasure, We were the honesty was, phenomenal. And unless there was $100,000 in there, and then they just said, "This is what we found." But
here's your baseball card, kid.
Yeah, here's your one baseball card back. It was really amazing. I don't remember all the contents of it, but I would agree with this guy that there is. He has a tag. You lost something, I find it. Dan, can you say that with the Massachusetts accent for us? I'm just kidding.
I notice his fee isn't in the tagline, though.
Yeah, that's characteristic.
You lost it, I find it, you get half.
Yeah. Well, that's going to do it for us. We're going to wrap up Money in the News, but we're going to be right back after this break. And when we come back, we're going to be talking about personality types. That, there's just different kind of personality types when it comes to working in or spending or saving money and all those things. Some of them are great. Some of them have some drawbacks. And some of them are, lots of people are hybrids of these personality types. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Take a quick break. We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about personality types. There are several personality types when it comes to working with money, and it's not all bad, but it's one of those things that we find really interesting when kind of working in behavioral finance and trying to understand why do people do with their money.
Well,
do what
Seth,
they do with their money.
You say that, and just what comes to mind, I think about the fact that the behavioral piece of this is something that we have to help people through. Because whether you're a saver or, a spender or a worrier, all the different, we have to work with that person because we have to get them to a point where they can get to a healthy point. And that's, sorry, as you're saying the behavioral finance, that's a great point.
Yeah. So what kind of a personality are you would be, I guess, what Ben's talking about there and trying to apply that and understand it in our personal journey with finance. We all have a relationship with money. And we're gonna have some of these traits that are going to be more prevalent than others.
Yeah, that's for sure. And I think the thing that is the most interesting when we meet with clients is the combination of the personality traits when someone comes in, right? You have a husband and a wife, and one person thinks one way about money, and one person thinks almost completely opposite. It's either almost agnostic or completely he takes too much risk, or, she doesn't let me do what I need to do. And, I do all the work. I don't handle any of it. Oh, they don't want to even come in. They don't even talk. They don't even like even thinking about money. It's not their thing. I mean, I can name 1,000 different phrases out there that represent any one of a zillion. I mean, we have 8 personality types today to talk about. And I think, if you're listening to this show, you say, well, I kind of know I'm this or I'm that. But I think the benefit you're going to get out of this is to understand when to combat the natural inclination of the personality type you're kind of born with, or you've learned, or you've acquired, to get yourself to a better balance, right? I mean, we all have inclinations to do one thing or another, and finding that median is really important. So, because when you approach money and you approach financial decisions and so forth, it, like Dan said, it's an emotional decision. Everything is emotional around this. So if you can understand all the personality types and start challenging yourself to become balanced and to make sure you're not drifting into one versus the other too much.
I think it's probably most important, and we see it every day with clients, is, for you out there as an investor to understand what your personality type is. When the topic of money and investing comes up, what's that initial gut reaction like? And just so, the importance in understanding that is so you don't create roadblocks for yourself. You're not creating blind spots, that you're able to keep an open mind to the conversation ahead of you, understanding that when certain topics and thoughts come up, that you're going to have a natural reaction to it. Because it's, you don't want to have those things stand in the way of making the right decision and creating the best opportunity for yourself down the road. So that little bit of self-awareness and comprehension of what's just natural for you to react in terms of making big, very important kind of longer-term decisions, trust the guidance that you get from your advisors is what I guess the bigger point. Make sure that your own personal inclinations don't prevent you from hearing what's being said.
Well said, Dan. Before we get too far down the road, you can reach us at 855-226-8551 or info@yourmoneyontap.com. And if you're listening to us on the radio today, we are a podcast as well. So if you missed something and you want to go back and grab that information, find us at Money on Tap on any one of the podcast venues. And we appreciate you listening. And we also, we love the call-ins and the activity that you guys are creating out there around the content that we're trying to deliver here today. So we've got, first and foremost, probably one of our favorites to see is a saver. And how do you know that you're a saver? Well, you might put away money endlessly, sometimes without any kind of a real goal in mind. It's just kind of a compulsion to you have to save. You might also be saving money just because it's what makes you feel secure in life. That's usually one of the goals or one of the things that's kind of an underlining motivation. If you're a big money saver, you're probably also very frugal. You might find that friends will come and ask you for advice on what phone company is cheapest or where the best deal in town for burger this week is.
Yeah, Seth, I think as we go through the concept of saver, right, it sounds great. Like if you're listening to this show and you're saying to yourself, I'm a saver. I'm the responsible party. I'm the person who's got it under control and I'm putting money away. It's like that sounds really good. But, as I think about savers, we love meeting savers. But if you're a compulsive saver, you can become really overly too cautious to the point where you actually cost yourself money, where you're no longer saving. And one of the things we've talked about on the show a number of times is the concept of inflation. Like in this inflationary environment that we're facing and we're talking about, if all you're doing is saving money in the mattress, like we talk about the $46,000 that guy found in the attic in Massachusetts, it's still only worth $46,000.
Exactly right.
It's less now. Compared to what it was then, it was like $500,000.
Yeah, it was almost $500,000, and today it's worth $46,000. That person lost money, but they were a saver. And so when you think about that person never pulled the money. Somebody who put the money up there, $500,000. If I put $500,000 in my attic, and I went through the depression and everything else, and at some point in time I never pulled it out, I became an unhealthy saver. And I think people have to understand there's both healthy and unhealthy in each one of these categories that we're going to probably talk about. Now, maybe not everyone will have a healthy or unhealthy, but people, say, well, I'm a saver. And that's just like, well, in a cultural environment, that just sounds good. Like, oh, you must be responsible. But that's not necessarily the case. And in this example, it's just actually like literally the perfect, money in the news article out there is to say, hey, saving isn't all what it's cracked up to be.
I grew up in, like probably all of us, my grandparents survived and went through the Depression. My parents were severely impacted in their growing up by that whole mentality and that kind of experience from the generation before. So saving was critical. My family very much was into, if you have an extra dollar, you put it in the bank. And it was just automatic. It was just what was expected. And that's the advice that they'd gotten through the generations. But later in life, when I was kind of beginning my career in finance, I got this other tidbit that I had heard someplace, and I can't even exactly place it, but it was profound, and I still live and believe it today, is that you can't save your way to wealth. You can't do it. You cannot possibly save enough. You have to invest.
That's a great line. Can't save your way to wealth.
Can't do it.
Yeah, there are several drawbacks to being, unbalanced in this relationship. You might be missing out on hobbies, and you might be passing up on time with your family, taking a vacation even. If that's the motivation behind why you're not doing something, that there's an imbalance there, and there is definitely a sacrifice. And
whoever buried that $46,000, they passed up a chance to take a vacation or buy that car or do whatever it was, and they died before they told anyone where the money was.
Yeah. Number two, folks, not the saver, the spender. You're a spender. You probably already know this. And you've had other people try to talk you out of making some of these decisions. But, what are the indications that that's you? You're buying just stuff you don't need. Frankly, you've got, a tendency to probably treat people to a special something just for no particular reason. You might be kind of like an emotional buyer as well. Like if you're kind of spending creates a satiating type of a feeling to alleviate stress for a lot of the more compulsive spenders that we find.
Yeah, I think I just identified my first hybrid too. My wife is a bargain shopper for stuff she does not need.
And she's not a subscriber to our podcast.
That's why I can get away with that, Ben.
I think that's an interesting piece about that, right? So there is the spender. We all know a spender, and when we use the word spender, there's that negative connotation too. Are there good spenders? I mean, you have to know when to spend and when not to spend, right? There's a balance of when to save and when not to save, and when to spend, when to invest. And but if you don't have, kind of guardrails inside each of these things where you're saving appropriately, you're spending appropriately, any one of these personality traits can really get out of whack. And that's one of the things that I think is a complicated issue for most of our listeners. I mean, there's not a person, any of us, I mean, I know both of you well. I've known both of you for, 20, 25 years. And we all know each other's pitfalls. I know your pitfalls. But we all have that, where we save, where we spend, what our personalities are. And honestly, it's the differences of us as partners and all of us and how we look at where we spend our money. I mean, I love, Dan is much more conservative financially than I am. Like, that's just our nature. Like, it doesn't mean that it's good or bad, but it's interesting because our balance in that conversation is really interesting as well. And then Seth's almost a little bit more out there. He's very in tune with where to spend money for a lot of the pieces that we need. And so, like, sometimes I look at it and say to myself, I might be middle of the road between the two of you, but then sometimes I know I'm not. But it's like I can jump into the spending thing very easily. Dan knows that.
Yes, he can.
Dan's ready to go recycle stuff. So how can we use this again? So, but there is a balance, and we all know that because we engage that in the industry. And I think that's something that, when God pairs you with somebody and you talk about your wife, I mean, you guys are probably perfectly paired, between the spending and not spending. So that's an interesting piece.
Separate checking accounts, Ben. Separate checking accounts.
Yeah, something else that I notice comes up for people as well is hiding purchases. If that's one of those things that's happened, then you probably, your gut check there is like, oops, I'm doing it again. So what are the things that we can do to, again, bring that balance back into the relationship here with money? And a lot of the times it's just a simple budget. And again, I would say simple is the key word here, because if it's not something that allows you to just take a look at what's the acid test here, really, that's what we're looking for, to know that we're staying in line with, what we've communicated with our partner or ourselves that we're going to try to do.
Another one of those lessons I learned early is, and this came from my father, he always said, pay yourself first. So when you talk about the notion of a budget, the driving principle there was whatever it is that you truly need or want to save for your future, whether it's inside of an IRA or 401k or just an after-tax investment account. If it has a specific purpose, if it's a need that you believe in and is long-term important to your family, that's the first item in the budget. So you don't save what's left. You save first.
Yeah.
And you spend what's left.
Yeah, and the same premise is, when I was taught about, even the concept of tithing, like I was always told, you tithe your first, God wants your first fruits. That's what it talks about in the Bible. And I think about that, and I was challenged by an older gentleman who I respect highly, and he said to me two things. He goes, when someone looks back at my checkbook, they'll know my walk in my faith by the first check I wrote from the second I'm paid. And I thought, wow, what a challenge that someone can see that you wrote your first fruits because it's not the way it was where, we had a farm and we're sacrificing lambs and, we don't have altars here, but it is what are our first fruits? And I just thought that was an interesting component to the same concept where you're saying is, what are you doing first with your money? That's a really good challenging point for anybody listening, whether you're saving and you're tithing, however that is that you're managing your assets. What you do with your first dollars is going to define what your priority is in life. That's really a big deal. And I was challenged by that many, many years ago. I'm not perfect at it. I don't do it every time. But I will tell you that it is a practice I try to live by, which is, anyways, that is what it is.
So one other kind of a tip or trick here that we've used with clients is if they're the spender, and this is right in line, I think, with what you're saying, Ben, is
burn
just
their
taking
checkbook, shred their credit cards the second they walk. No, I'm just kidding.
Well, the budget has kind of like that put everybody on a diet feel to it, and if you're not liking what you're doing, you're probably not going to continue to do it. It's just the way that people are. So if you can create a mindset around some saving activities or some spending activity, that's the transformation for a lot of people that are big spenders, is allowing themselves to see that they're spending money and how they're spending the money, and still kind of get that connection for them, that payoff is what they're looking for. And so it doesn't feel like they're losing money or they're just giving it away.
That's an interesting point. I used to say to people all the time that the easiest way to save money was to stop eating out at restaurants that have waiters or waitresses, because that's 10 or 15 or 20%, however you tip, right? Well, maybe you don't tip. I don't know. But if you tip, like if you go to a place where they're serving you, that if you stop doing that and just go to a Five Guys or you can have as much fun with your family at some of the more casual places than a more official dining place. And then if you're going to get coffee versus a big dinner out. Now, with COVID, that's changed a lot, right? But that's still something that I challenge my wife and my family with it. We intentionally look for places, like my kids know this too. We're like, all right, no, Dad, let's sit down. We're going to have to pay a tip on that. And it's not to be cheap. It's just to be responsible, right? So I can choose to pay the tip, but I go to places where it's not a requirement. Now, I'll tip anywhere I have to tip, but that's something to watch for. It's a simple way. As we open back up and maybe you're used to not eating out and going to that more expensive restaurant with an expensive waiter, that's a way you can start curbing, because we've already changed our habits about how we live our everyday life. Start when you exit, can you create new habits, create a new path to go.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're going to take a quick break and we'll be right back. Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Krussman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show and we talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical, and so many people just leave this part out, and then they find out later, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we're talking about personality types and the different kinds of personality types that people revolve around when they're, connected with money, have a relationship with money. We've got the saver. We've got the spender. And we've also have several others that we're going to try to cover before the end of the show here, so we might have to start pushing the needle a little bit, Ben. And again, Dan is here with us today. Dan Michelon, partner with Brayshaw Financial. It's good to have you on the show again and adding your wisdom and your experience here with us today.
Let's not go too far, Seth. But thanks, Dan, for being
Just trying to bring it up a notch here.
So you're like, oh, I'm not a saver. I'm not a compulsive spender. Maybe you are a money maker, right? Maybe this is your obsession, is that you think that making more money is the secret to happiness. You spend a ton of your energy just trying to make as much money as possible, and you really get a lot of pleasure out of the activity of getting approval and recognition from people about your financial success.
This is a big issue in our world, right? Because we live in a materialistic world. It's something that, and we're in the business of making money for people. So we have that, right? I mean, there's that, I hate this phrase, but, people invest out of need or greed. I mean, that's like they say, those are the core elements of everyone's investment decision. So trying to balance that. And if you're listening to that, it turns you off a little bit. I'm sorry, but it's just a phrase that's used in the industry. These are the concerns, and you have to figure out which one they're looking for. The person who's looking to that compulsive, that moneymaker guy is the one who doesn't accept simple success. Like, we talk about trying to make success. We talked about people, hey, listen, we try to do that 7 to 10% return over a 5-year period. That's kind of our goal conversation. Have we beaten that? Yes. Have we had years where it's lower than that? Yes. I mean, all those things exist. But the thing is when you're like last year, we had a very, very good year. And when that's not good enough, that's when I get very concerned about the client. I try to have to explain to them, hey, listen, these are your expectations. This is where your expectations should be. When we beat that, don't create a new expectation that we never defined as the case. And so the compulsive moneymaker, that person is the one who will leave us when the return is not as good as this great year. Like the person who says, well, they must have lost their steam. Well, we never promised to do the returns we did last year. I know that, So going through that concept, that's a very dangerous place to be.
Yeah, and to the catchphrase that people invest out of need or greed, what I see to be the case is, a lot of people, especially when you're meeting with an investor who's starting off young or at least young in their financial life, they save and we invest and you plan on the basis of need until the need is met. But generally speaking, once you've gotten there and you think it's a victory from a planning perspective, and it is, but you don't want to stop there, right? So they want to continue to grow and to shepherd that wealth and to continue to add assets so that their perspective about what retirement might look like or whatever the stated goal was can improve. They have that opportunity to kind of broaden their horizons and to consider the possibility of doing more. Now, is that greed? Well, I mean, you're taking money and you're hoping to grow it, but what's the money for? I mean, there's lots of things that we do as planners with clients that are, tremendously generous and do a lot of gifting, and you find, different people and organizations and groups that you can find a way to support with that additional wealth.
Absolutely. Next up, we have the person who's indifferent to money. We get a lot of that. I mean, I usually get a lot of that, Dan. I don't know, when we sit down with clients in the conference room, it's, my wife didn't come. She doesn't really do any of this stuff. This isn't what they handle. I get that a lot. Tends to be more of a, financials tend to be more male-dominated in households, I would say on average, though my mom was the, financial, crucial piece. She was brilliant financially. And where my dad, when my mom passed away, my dad hadn't written a check in over 40 years of their marriage. I mean, I was like shocked by that. So that tells you my dad actually got an allowance, to be honest with you. So, but and there's relationships like that, and to be indifferent is really, I think, probably one of the worst positions to be in. I really do, because being indifferent means that you have no impact on the benefit of the gifts you have, because if you don't choose a side, the decision's already been made one way or another. Someone else is making that decision. And I encourage, if a spouse says, I don't want anything to do with it, I don't do business with them. Like I say, listen, you don't have to be here for every ounce of everything, but you need to understand what we're doing. There's no excuse for exiting the business. Like even with discretionary accounts where we manage assets at full consent and et cetera, I mean, we don't really have a problem with doing that as long as we know that the client understands and everyone's aware of what the overall picture is, the understanding of the, we're not looking for someone to handhold ourselves through the trading process, but we do want people engaged, and that's healthy. It's unhealthy to be completely unengaged.
You have a responsibility to your family to at least maintain awareness. I mean, at the very least.
Yeah, and if you're a husband or wife that don't want anything to do with it, that's okay. I wouldn't condemn you for it, but I would say that you have to be willing to engage. You don't have to do – because the thing is each one of you brings something to the table. Each partner is, I look at the three of us, we each bring something to the table, and over the years, and we've had our, disagreements, or, we've bent this way or that way to make things happen. Usually I win. But the thing is like, but honestly, as I've gotten older, I've realized the value that God has given me by having you guys as partners, because honestly, it's challenged me to really be more astute and aware of things that I'm not, because I don't have all the answers. I mean, we all think we do, right? I mean, we all think, we're doing it the right way. We live in that naiveness, but I think as we get older, we become more aware of the gifts that are around us on a daily basis. I mean, there's a zillion things. I look at Dan and say, man, I'm so glad I didn't do that, but I don't want to tell him. Okay, maybe it's one.
So we haven't hit it out of the park for you yet. Well, maybe you're a little bit of both of these things. Maybe you are a saver, but then occasionally you turn around and you're like, where did it all go? Because you're also a splurger at the same time. And, this can be a little bit frenetic for people on the outside, just trying to observe the pendulum swinging from one side to the other. But this is certainly one of those personality types that I think Ben might identify a little bit more with.
I would definitely identify with a saver-splurger. I would definitely do that. I'm not, I like nice things, but I don't spend money where I don't. If it doesn't mean anything to me, I'm not going to spend the money there. Like if it's not, I know people that are splurgers and they just, whatever they're doing, they spend. But like for me, like my wife will say, man, sometimes he's really cheap. And then sometimes she'll say, boy, he'll really just spend money on anything. So, but I have intent, and that's how I define it. I would definitely do that. I would probably say it's probably on the more healthy side of the trade. But yes.
Yeah, this is an ongoing learning experience in my household too. My stepson's in band, and he's very much into it, and we're happy for him. He's done a great job, but he's been working for a couple of summers, and we've been helping him. A little bit of an allowance for work around the house, and he'd saved up in a checking account that we opened for him, and I was very proud of him. He's up to $900. I couldn't believe it. And in one fell swoop, one trip to the music store, comes home with $0 and a new trumpet. And I was shocked. I was absolutely shocked that was the decision he made, because we'd been trying to kind of impart this lesson on him. And early on, we'd split the allowance. He could have half in cash, half went to the account, and we're trying to build some disciplines. And I really thought we had him there. And like I said, one trip and gone.
Dan, I could see it in your eyes right now. I could see. Hey, you're going to need that trumpet when you're living on the street. That's the only way you're going to make money.
I hope it came with a hat to collect nickels. But.
That's maybe a good way to look at it. He's seeing this as a real investment and something that maybe he can earn an income out of. But I don't know. Might take a minute before that turns into something else. So what is some advice that you would like to give, Dan, to the the saver/splurger when they've maybe they've got a big purchase that's coming up, or they're thinking about that big purchase.
I know exactly what Dan would say.
Think again. Don't do it.
You would just be like, no. No, but I think the thing is, I'm one of the problems a lot of people have is the saver-splurger relationship, right? I think that's, Dan kind of alludes to that. I mean, like, my wife and I, we probably have a saver-splurger relationship on some level. I mean, so these relationships, like I don't meet many husband and wife savers. But I do see saver spenders all the time. And I do see that kind of offshoot. And then I do see people who are both saver splurger kind of people that are paired together. And then the highest conflict relationship I see is probably what we would bring into the next one, which is the gambler. The gambler, there's always like one gambler once in a while, and then they get connected with an ultra saver. And that is a very dangerous. I usually find that that's where most of, the rocky road in the financial world actually hits. And they usually need a mediator to get through it. They usually need someone to say, hey, listen, you're both way out on left field. One person thinks buying stocks or bonds might be too risky, like, buying an ultra conservative, maybe you're buying the U.S. Treasury and the person's like, that's way too risky, and the other person's like, well, you know what? I got 4 stocks that, just went public and, they got like, they're SPACs, or something. And I want to put all our money into it, That's a real problem. And those people usually need some sort of regular balanced person in the middle. That's usually where we play a big role, I would say, for a lot of people to look at that and try to say, just because of how we personally respond. I think about it, Dan, like when we do investments, Dan and I are different financially, and so Seth. But when we do investments, we usually are all very similar in our track. Like, we usually are kind of interesting that way when you think about it. I hadn't really thought about that before, but we don't really have any conflicts about the investment world. We have our investment committee. We go through it, right? We're not, okay, well, we're pretty nonchalant about it. So that's interesting. So I think because of that, because we're taught, we have training, we have that education, we have the background, we bring that kind of solidarity to that. Now, how I live my own personal life and I spend my own dollars is potentially a different scenario, right? Yeah,
and I think that's, getting back to your point there, when we're looking at the portfolios for our clients' money and their wealth, and we are able to make decisions in agreement on that, virtually all the time, like you said. And it's because I think we're focused in those moments on our clients' goals. It's got less to do with our personal preferences and maybe some of the decisions we might make with our own money.
Right.
But when the focus is clear and the outcome is something that we're all looking towards on behalf of our clients, it's a little easier path to see.
Well, how many times do we go to tell a client, like, listen, we should sell this stock or get rid of this ETF or whatever it is, and they're like, well, it could keep going up, but we have such an unemotional connection to it. They were like, just the other day when we were talking about my stock portfolio, I brought Dan in. I was like, listen, take a look at this thing. I just need an unbiased opinion.
Right.
Because I get, just like anybody else, we have emotional connections to different assets, or we believe certain things can happen. We're like, no, that one's gone. This one's in. He doesn't care. Generally he does, but that's important to have that person in your life, and that's just to kind of work through those different pieces. So
yeah, for us, it's easy. I can't tell you how many times I've just fallen in love with a stock for all the wrong reasons, and you hesitate to sell when it's down, and when it's up, you can't see the forest for the trees when you should make that decision. You know what? I've made enough. All right, this is it.
Yeah.
The goal's been met. I see it all the time on the financial shows, and when they're kind of picking on some analyst because he sold too soon. One of them has the catch line. It says, "You never apologize for taking a gain."
Yeah, I love. I know
that's so true.
Yeah. It is so true. I have a friend of mine who bought Chipotle at like $6 or something like that. I don't know. And he's like, he sold half of it when it went to like $40. He's like, "This is ridiculous." He sold the other half. I think when it like hit, I don't know, it was like $89 or $90. It was like, I think it was just shy of $100. I'll have to ask him. I'm actually going to see him later today. I'm going to ask him that because I'm just curious. Chipotle is like, I don't know, $1,400 or $1,500 a share or something like that.
Yeah,
he's still kicking himself. I'm like, well, what do you care? You went to something else that's making money, move on. But it is funny. We all have those stories. I remember I bought Sirius Satellite Radio accidentally in the wrong account and whatever, and it had to reverse the trade. But I bought it for I think it was 6 cents. And then it went to 8 cents, and I was like, forget it. I lost my gain. So those are things.
Next up, we have the worrier, which sometimes might kind of coincide with the super saver or the really frugal characters. But I think this might have a little bit to do with our money in the news, $50,000 that was stashed away in an attic. I think the equivalency was around $500,000 of today's money. If you're putting $500,000 in your attic, you might be worrying a little bit. There might be some concern there. But the worrier it doesn't really matter how much money they have. They're just constantly worried that they'll lose it. And they're really, lack a lot of confidence in their abilities to achieve the financial freedom that they crave. And this obsessive behavior really limits the joy in life for most of our worriers. That's one of the things I find more often than not, is that they just don't have joy when it comes to being able to, experience life and financial freedom.
I think, and I can relate to this a little bit. My favorite place to see money is at, on a statement. Generally speaking, I like to see it there. And I think a lot of worriers feel the same way. But I think some people are generally happier in their investing and saving lives when they picture the assets on the page, not as the numbers in a spreadsheet that they may be, but they have the vision of what they hope to achieve, whether it's that retirement home, a boat, a car, the kid's education, so they're taking the assets off of the page from the black and white and making it to them the vision of a tangible goal, a tangible outcome that just means more to them than the dollars.
Yeah, the worrier, we get phone calls from the worrier, right? The worrier comes in, they're trying to overcome the worry, they do some investing, and then we get a lot of phone calls like, hey, listen, market, what's this, what's that? And that's a complicated person to work with, for us at least. And sometimes we can help pull people out of the worry hole, I think, and then sometimes we can't. And that's a... that really can be a very dangerous place, and that's where you put your $46,000 or $500,000 in the attic, and it just goes down. I think with inflation too, for our listeners, if with inflation kind of roaring at us, and it'll be something that mathematically goes through, I think, the entire market. I mean, if you're spending more on something and you're invested in the market's going to rise from that inflation. It's just that the whole revenue process, the whole way it works, generally moves that way. But if you have cash sitting in the bank and you're concerned about crisis, upheaval, the U.S. dollar, one world currency, if you're in any of that conversation, I think the U.S. dollar or cash in your pocket is the absolute worst place to put it. I mean, mathematically, I can make an argument 10 ways to Sunday how you could put it in almost anything else and you'd be better off to deal with inflation or to address those items. You can do inflationary U.S. government assets. You can do a lot of different pieces, but anything's going to be better than the bank unless you're planning on spending those money on various things.
Yeah. Last but not least, I think the extreme that we have is the hoarder. People will do that as really an attempt to be so cautious that it just consumes them, and they can't get out of that fear of loss. Most of the time, a hoarder is not going to be somebody that is really giving, not going to do any loans, not going to do any lending, not going to be giving to any organizations, but kind of ruined by the fear of loss in their life. Folks, we hope that you have enjoyed your time with us here at Money on Tap today. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You can also find us at Facebook. We're at /3D Investing. We're also on Twitter at BFG_LLC. And as always, you can also find us at yourmoneyontap.com. It's been a lot of fun. Thank you, Dan Michelon, for exploring the different personality types around finances today. And if you are new to Money on Tap, you're welcome to give us a call. We love sitting down with listeners and just hearing about stories in their lives and sharing our experience and understanding around personal finance and financial planning with you too. Make it a great week, folks.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.